This is Concrete Numbers, where construction meets accounting, tax, and business strategy. I'm your host, George Kazarian. If you're ready to scale your construction business and master your finances, this is the podcast for you.
Hey everyone, welcome back to the channel. And today what I want to talk about is a very underutilized strategy. It is converting your personal vehicle to business use. And this is one of the greatest strategies there is, and I'll tell you why. Because it doesn't actually require any new capital outlay the way pretty much almost every other deduction might. See, when you buy a vehicle for personal use, it's basically not deductible at all. However, when you convert it for business use, now you unlock the tax advantages. So what you're doing is you're taking money you already spent, a sunk cost, and basically making a tax advantage out of it. Now I want to give you a very simple example on how this can be done. Let's say John bought a car for $80,000 back in 2022, and it's now 2025, and John starts using it for business use, let's say 70%. Now he bought it for $80,000. However, today it's worth in 2025 it's worth $40,000, and he uses it for 70% business use. Now in this case, John can claim $28,000 as his basis for this vehicle. Now let's take a step back. So he bought it for $80,000. It's now worth $40,000. The way the rules work is you need to take the lesser of the fair market value or the cost basis plus improvements. In this case, the fair market value is $40,000. However, the cost, and we assume there's not been any improvements, is $80,000. So in this case, you would take $40,000 as your basis that you would put on your tax return. Now the next step is we know that he uses it 70% for business use, and this would require, documentation on his end, mileage log, client visits, deliveries, things like that. But the biggest thing is mileage logs. And anyways, as long as he could prove that he does use this vehicle 70%, then, he's all good there. So one thing I do want to call out is if you were to call it 100% business use, you better have that documentation straight. And that 100% is a harder bar to cross. Even if you dropped it, even if you do primarily use it for business, you have your mileage logs, everything, and you call it 90%, 80%, there's at least some wiggle room. Because if you're claiming 100%, you better have the title, you better have the insurance, like everything needs to be completely business related. If you're a little unsure, first of all, of course I recommend that you get your documentation straight. But second of all, if there is a little, haziness as to exactly how much business you used it for, I would recommend you allow yourself some wiggle room. Make it, 70, 80, 90%, not 100%. 100% is a much higher bar to cross for sure. Now there's two types of depreciation that can be allowed to accelerate your normal depreciation, and that is either Section 179 depreciation or bonus depreciation. Now unfortunately for used vehicles, Section 179 depreciation is not allowed. However, bonus depreciation is allowed, and it still does give you a pretty generous break. Now with the OBBBA, we got 100% bonus depreciation back for 2025, which is great news. But not all cars are treated equally. If your vehicle is over 6,000 pounds, you would qualify for 100% bonus depreciation, which is great. You can, buy a car for $100,000 and effectively take that $100,000 as, accelerated depreciation in your first year in the year of purchase, even though you haven't necessarily paid that amount. As long as it's, paid in cash or financed, then you qualify for this. If it's leased, then, not so much. You would expense exactly what you're paying for the lease payments on a monthly basis. Now, if your vehicle is under 6,000 pounds, there are limitations on how much depreciation, even with bonus, that you could take, year after year. So I'm actually going to put that right down here. This is straight from the IRS website, straight from the actual OBBBA bill that was passed. And basically, you can take $20,200 up to $20,200 in 2025 of bonus for a vehicle placed in service in 2025. You can take $19,600 in 2026, $11,800 in 2027, and for each successive year thereafter, you could take $7,060 until the full thing is depreciated. So obviously there is a big advantage, in terms of accelerating your depreciation in buying a vehicle that's over 6,000 pounds versus under 6,000 pounds. Now, back to our example with John. He bought a vehicle in 2022 that was 80,000. In 2025, it is now worth 40,000, and he uses it 70% business use. So that means that he has a total basis he can use of $28,000 that he can put on his tax return. However, with the bonus depreciation, he's basically capped at this 20,200 figure, assuming his vehicle is under 6,000 pounds. Now, if his vehicle is over 6,000 pounds, he can take that full 28,000 in the first year and be done. If it is under 6,000 pounds, then he is capped at this 20,200 figure for the 2025 year. And he can take the remaining 7,800 in 2026. I mean, basically for effectively doing an accounting change, a paper change, he, over the span of a couple of years, got himself a $28,000 deduction. So, I mean, that's pretty good. There's few tricks in accounting where you can just make a paper change and get a tax benefit out of it. Now, what happens when you sell the vehicle? So losses and gains on these, personal use vehicles are treated a little bit differently. Now, if you have a loss, basically you would calculate that loss by taking, sales proceeds minus the adjusted basis, which is the fair market value less depreciation. If you have a gain, you can actually take sales proceeds less the original cost basis, and of course discounted for your business use percentage. So that actually gives you good leeway in that when you're using your original cost basis, you have less gains to report. And we all know that pretty much every car depreciates over time, but mind you, collector cars can actually appreciate. Now, I get this question a lot. If I convert my personal use vehicle to business, then do I need to transfer the title and insurance to my business as well? So the answer to that is the IRS does not actually require you to transfer the title and insurance. However, they are more based on the eligibility of the business use. That is, you need to have some sort of documentation or some sort of methodology or basis of what your business use is. And if it's called into question, the number one thing I would recommend is mileage logs. You have some sort of a log. MyLikeU, Hurdler, Everlands, like one of these apps, or you could just do it in Excel, or do an estimation like once a week, once a month, whatever. However you want to go about it, but there needs to be some sort of a log, and that's the biggest thing on eligibility. So it is valid to use your personal vehicle for business use. It's just the documentation, really. If you were to go as far as convert as claiming 100%, at that point you probably should have title and insurance transferred over. Also, what would matter in this is the entity type. If you're a sole proprietor, then it's perfectly fine to have everything completely under your name, and there's kind of no other way to do it. If you're an LLC or a corporation, again, if it's only partial business use, it's not full business use, you could keep it under your name and everything. However, again, you need the documentation. And, if it is primarily business use, almost not quite 100%, almost 100%, it is cleaner to transfer it. But I will warn you that once you transfer the title to you can have the title added to your, DMV registration under your name. But if you do a full, conversion or switch, then at some point, then your insurance is going to require you to get a commercial policy as well, which is going to be more expensive, that's for sure. So again, it's not an actual IRS requirement to have your title and insurance transferred over. It's more of a documentation game. I hope you found this helpful. This is actually one of my more favorite tax strategies. it's a low-lying duck, and again, it doesn't require any cash transfers, contributions, cash outlays to actually get the tax benefit. Again, if you enjoyed this, found it helpful, please hit like, subscribe, turn on notifications, and we'll see you in the next one.